Hello, class, and welcome to your final unit in this fast-paced class. Congratulations for making it this far. Keep up the hard work, finish strong. Our final unit here is going to be over chapters 9 and 10. 9 is long-term liabilities, and 10 is equity section. Okay, so let me get some stuff started here, and I'll get my screen shared with you. And we'll get into this. Swap. All right, chapter 9, long-term liabilities. You're gonna need your chapter 9 outline for that. That's what I'm gonna go through while we go through these slides, and then I'll have that handout board video for you available as well. Long-term liabilities, I cut a lot out of this chapter from the book, so we're not going to cover everything. There's 3 main things we need to know here. Describe what debt securities in the markets in which they're issued. Basically, we're going to be talking about bonds, how to record and properly present bonds at the time of issuance, and then how to use the straight line method to record the premium or discount amortization and properly present these bonds onto the balance sheet. Okay, bonds are long-term debt. Long-term debt refers to obligations that extend beyond a year. So you could have a note payable in your long-term debt if it comes due after 12 months, if it's a 2-year, 3-year, but most of the time, like when we did current liabilities, we said no payables are mostly in that 3 to 12 month range. Okay, long-term debt includes bonds, which is long-term borrowing from the public. It's usually a large amount spread out over 15 years, 20 years, 30 years. On that one, okay? That's how most companies raise their money or raise their cash, their capital. If they don't want to issue more ownership in the company, instead they'll take out some debt. Okay, and you say, well, why would they want to take out debt? Well, maybe they're paying 5-6% interest, but they're expecting to buy assets with that debt. That's going to generate them a 10 to 12% return. Okay, so the cost of the debt is acceptable because they're making a return on their investments. Okay. About bonds. Bonds are usually issued at face value of 1,000. Okay, they're issued and they're expected to pay back at the maturity date. They are traded on the public market as well. Okay, well, let's back up a little bit before I start talking about it being traded on the public market. Let's talk about they're issued in 1,000 face value increments. So when you buy a bond, you would buy a bond in the company and you have to spend at least $1,000, okay? $10,000 would get you 10 bonds. Okay. The face value of the bonds that you buy is what is going to be paid back to you at the maturity date when the bonds become due. There's also going to be a percent on the bonds. Okay, that is the amount of interest that the bonds are going to pay you. So to find the interest, it just as we've always done before, it's on the bottom there. It's the face value of the bonds, which you are going to get at maturity, times the interest rate of the bonds that are stated on the bonds. Okay, that is known as the stated rate or the coupon rate. And then multiply it by a time in years. Again, okay, so usually bonds are payable every 6 months. So you're going to multiply it by 1/2 or 6/12. Okay, sometimes the problems are going to give you, they're going to be annually. So it'll just be times 1 when you get to the end for 1 year. Okay. So here we have semi-annual payments. 1 million times 6% would be 60,000 per year because that is an annual percentage rate divided by 2 because it's semi-annually. $30,000 is the total interest paid in March on those. Okay, different types of bonds that we have. Well, going back to your outline here, we're going to get into it in just a minute. Okay, what we're doing here was to find out what exactly is paid out in cash. Okay, when it comes to bond interest payments, there's going to be also an effective or a market rate because bonds are traded on the open market. Okay, so this effective rate is going to play a difference in what we're actually going to charge to interest expense, and what we're going to receive in cash when we actually issue the bonds. Okay, and this is going to create discounts or premiums. That's just kind of a little preview. Types of bonds we have: secured bonds, bonds pledged with collateral, mortgage bonds, by real estate, unsecured bonds, a bond with no collateral attached. Those are your most common types of bonds. Okay, most companies are going to issue unsecured bonds. You're just going off the credit worthiness of that company if you want to invest in them or not. Okay. Important to know here, there are a term you might have heard of: junk bonds. Junk bonds are ones that are very high risk, so they pay very high interest rates. You can usually invest in them fairly cheaply, but you're taking a big risk. Okay, so when you hear financial analysis talk about junk bonds, that's what they mean. They mean bonds. So companies are out there that's very risky. Okay, the next two we're not going to do any accounting for, but I want you to remember what they are. A callable bond means you buy bonds in a company, so you're a debt holder when you buy bonds, right? Or you're a creditor, debt holder, because they're in debt to you or a creditor. Callable bonds allow the company to call them back early and pay you off early what they owe you instead of at the maturity date. They're going to give you more money. It's going to create a loss for the company. Okay, but it's a way for the companies to retire their debt early at a little bit of a loss. Whereas convertible bonds, you are a creditor to the company, and at some point in time, upon your choosing, they allow you to convert those bonds into stock. So you go from being a creditor to being a owner. All right, so this is what I was talking about here. The market value of bonds is not always going to be the same as the stated value. Okay, so maybe when a company decided they were going to do bonds, they have to go through a thing making a bond indenture, which is basically the contract between the bondholders and the corporation. And then they're going to assess their credit risk and what they're going to pay. Okay, and they might say that they're going to pay 6% interest on these bonds that they're going to issue. Well, now this is going to go through the board and the approval process, and it's going to get reviewed by the SEC. And there's a lot of regulation that goes into it before those bonds can actually be issued to the public. So while that is happening, since these bonds are traded in the open market, there's bonds of companies with similar risks that are already floating around out there. And what they're paying in interest is going to vary from what we decided we were going to pay in interest maybe 6 months ago. Okay. What we decided we were going to pay, we put on the bonds, that is called the stated rate or the coupon rate. What is going in the marketplace for bonds of similar risk is the market rate or the effective rate. Okay. We're also calling it yield. Yield is another name for the coupon or the stated rate. Okay. So when the yield or the coupon rate is greater, they're calling yield as the market rate. Okay, sorry about that. Didn't mean to confuse you there. The yield, the market rate equals the stated rate. The bonds are going to be sold at their face value, meaning you're going to receive the same amount of cash as the face value. When the market rate is greater than what we state they're going to pay, think of it this way. If the market's giving more interest than our bonds, is anybody going to want to buy our bonds? No, they're not. So we're going to have to offer them at a discount. We're going to have to receive less cash than the face value. On the other hand, when the market is less than the stated rate of interest, meaning we're going to pay more interest than what's currently available in the marketplace for bonds of similar risk, everybody's going to want to buy our bonds. So therefore, we're going to sell them or issue them at a premium. Okay, we are going to receive more cash than the face value of the bonds. Okay, I want you to be able to understand that both ways. Okay, because here is saying is market is greater than the stated rate of interest. You can also say the stated rate is less than the market rate. Understand that concept that when the stated rate, what we're paying is less than the market, nobody wants our bonds, so we have to lower the price, sell them at a discount. Okay, And then the exact opposite is true as well. Just gonna check this. Preston Manufacturing issues a 2 million bond offering with an 8% stated rate of interest. At the time of the bond issuance, the market rate of interest was 12%. It is sold at what? So the market is at 12. We're offering 8. People can go out on the market and buy bonds and get a 12% return. Why do they want to buy our bonds and get an 8% return, right? The only way we're going to get them to buy our bonds is if we offer them at a discount and sell them lower than the face value. So actually, we're going to pay them back more money than they give us at the beginning in order to make up that difference in the interest rate. Okay, so accounting for this long-term debt, when we issue it, there's going to be a premium or a discount, okay? Whenever we, if it's going to be, no matter whether it's a premium or a discount, it is going to be attached to the long-term liability. It's kind of like those contra accounts, the accumulated depreciation and the allowance for doubtful accounts. It's attached to those specific accounts. Well, the premium and the discounts are always going to be attached to the bonds payable. Premiums get added to the bonds payable, and that's how we're going to present them, okay, on the balance sheet. So if we had $100,000 in bonds payable that we issued at a premium of $3,000, our long-term liabilities are going to show that we owe $103,000 because that's the amount of cash we received. So we're going to go through a process called amortization that'll slowly take care of that premium and that discount. Okay, it's important to know that premiums increase the liability on paper, while discounts decrease the liability on paper. So here we issued 100,000 face value with a stated rate of 5% due in 5 years with interest payable. Okay, so prepare the journal entries, assuming the bonds sell for 1 par. When it sells for par, that means it's selling for its face value, right? What it's supposed to be, okay? So if we get $100,000 and the market and the stated rate are exactly equal at 8%, we will receive $100,000 in cash on that day with a debit, and we will credit bonds payable, which is always, always, always credited at face value. Okay. For number 2, it says assume it's at 1 for 103. Okay, sometimes it's going to tell you they received $125,000 in cash. Okay, you need to realize when we receive more than the face value, that's a premium. Another way they might state it is they sell for 103. That means they're selling for 103% of their face value. Okay, so we have to take the 100,000, multiply it by 1.03, and that's how much cash we would receive. Okay, that's what's done here. We receive cash of $103,000. Bonds payable credit always, always, always at its face value. Since we receive more cash, we get a premium. So we would credit an account called premium on bonds payable in order to make our journal entry balance. Okay, and then the exact opposite is true when it's issued or sold at 96. It's mean we're only getting 96% of the cash value of the face value. So we take our face value times 96, we get $96,000. The bonds payable still have to go on the book at $100,000 because that is what we're going to pay back at the end of this period there. And now to make it balance, we have to say we have a $4,000 discount on bonds payable. Okay, so those are your journal entries for issuing bonds payable. Next, we have to recognize the interest expense and the repayment of principal. Okay, so when we're talking about interest expense, there's 2 things we're going to need to know here. Okay, 1, how much cash are we actually paying back to our bondholders, okay, our creditors? And then how much of that cash is actually going to be recorded as an interest expense on our income statement? Because we are going to go through a process of removing that discount or that premium off our books through a process called amortization, okay? And there's two ways to amortize that premium or discount, okay? The effective interest rate method, we are not going to talk about, okay? Know that it's out there. That's when you get into intermediate accounting, you'll do a lot of this. You'll be making these amortization tables where you'll be taking that into account. But I just want you to understand the general concept of getting rid of that premium or discount. So we are only going to do the straight line method, where we are basically going to take the total discount or the premium that we had at issuance, and we're going to take it off in equal increments throughout the life of the bond. All right. So here we go. Interest expense for bonds sold at par. Remember when we did this before, our very first entry was to cash for $100,000 of bonds payable. Okay, as you can see, they're paying interest annually, only one time a year. So at the end of the year, 100,000 times the 8%, which is the stated rate, not the market rate. Okay, here they were the same, but it's always the stated rate, times 12 over 12 or 1 for 1 year, shows that $8,000 in interest will be paid. That is an interest expense in cash going out. As you can see, we have not changed our bonds payable at all. Okay, we just have an interest expense of $8,000 every year for the next 5 years. At the end of the term, when it is all done, then we can remove the bonds payable for $100,000 of face value, and we pay out the cash to our creditors to pay off the bonds payable. Did we change our numbers here? All right, yes, we did. Okay, so Friends Incorporated issues 5-year, 100 million, 8% bonds at 99. So if they issued them at 99, that means they're only receiving 99 million of the 100 million that they're offering, meaning they're going to get a discount. Okay, and it tells you right there, the discount is $1 million. Interest is paid semi-annually on June and December 31st. So record the issuance of the bonds. We would receive cash of the 99 million. Bonds payable is always credited, okay, to the face value. And the difference, our discount is a debit account here because we got less cash, makes it balance out. And there's your original journal entry. At this point in time, the bonds payable are listed on the balance sheet as we owe 99 million. But you can see, we're going to amortize this discount off. So we are going to amortize it over the life of the bond, and we're going to do it in a straight line method. So here we need to find out how much are we going to amortize each time we make an interest expense entry. So we have $1 million in our discounts on bonds payable. We are going to have 10 periods of interest where we make interest payments, okay? That is because it is a 5-year bond paid semi-annually. So we're gonna do interest twice a year, 5 times 2. That is what makes the 10 interest periods. So every time we make an interest payment, a cash payment, $100,000 of the discount is going to get amortized or removed from the books. Okay, when we amortize a discount, the discount is going to increase the amount of interest expense that we charge to our income statement over the cash that is paid. Okay, so we calculate here that our cash paid is the 1 million times the 8%, the stated value, times the 6/12. Okay, so $4 million is going to be the interest payment for this. That's the cash that's going out. But this amortization at discount, since we got less money, it's going to increase this expense when we put it on our income statement. Whereas the premium is going to do the opposite. Okay, so here's what your journal entry would look like. We have cash going out of 4 million. That's what we calculated. Okay, the face value times the stated rate times the period. Our discount on bonds payable, remember we are removing it. So when we put it on, it was a debit. So to remove it, we need to make it a credit. Which in turn, as you can see, to make our journal entry balance, puts it up at 4,100,000. So now when this whole thing is done, and we've done this 10 times, okay, this discount on bonds payable now equals 0. Okay, and then when we get to the end, we still have the bonds payable of 100 million on the books. So we remove that and we put the cash out of 100 million. So what we're basically doing is taking that $1 million difference between the cash that we received and the cash we got to pay back at the end, and slowly expensing it on the income statement over the life of the bonds. Okay, when we do premiums, it's going to do the same concept. As we're taking it off, it is going to make the interest expense lower than the cash paid. And by the time we get done at the end of the bonds, that premium account is going to be moved all the way to 0. Okay, and then we'll just pay back the full amount of the face value, even though we receive more cash up front. So here we issue 5-year, 100 million, 8% bonds, just like we did the last one, but this time at 102, meaning we received 102 million. So 100 million times 1.02 or 102%. Creates a $2 million premium. So we record this, our cash is 102, bonds payable, always, always, always at face value. And the difference here being a credit becomes a premium. So next, using the straight line method, we have to calculate how much of our premium are we going to amortize off each period. Okay, there's 10 periods, the 5 years times 2 payments each year, semi-annual payments, means we are going to amortize $200,000 off of our premium when we start doing it. Here's what I was saying, the interest expense equals the payment, the cash payment, which is the same, the 1 million times 8% times the half a year of $200,000 of $4 million is what it comes out to. We're still paying out 4 million in cash, but premium amortization makes the interest expense lower. So our interest expense is only going to be 3,800,000. And this proves it in the journal entry here. As you can see, cash payment, cash going out. We have to pay what we're listing on our bonds. Premium comes off. And as you can see now, our interest expense is lower than the cash. Very important to understand the relationship of interest expense to cash when bonds are issued at a premium or a discount. And then once again, when we get to the end of this period of the bonds, they become mature. Okay, the premium is totally wiped out. There's nothing in that account because we put this entry in there 10 times. The bonds payable comes off the books and we pay back the money that we borrowed. Okay. The effective interest rate, I'm going to touch on it in just a little bit. We're not going to do any calculations with it, but it takes whatever the market rate is at the time of issuance, what created that premium or discount, and it's going to take it that discount by that rate and lower it by that percent over the life of the bonds. Okay, so it's going to create a higher interest expense at the beginning. Okay, or we're going to, or say a higher amortization. So whether it's a discount or a premium, whatever is amortized off is going to be heavier at the beginning. And then as it goes further in time, as it gets closer to the end, the amount that is actually taking out of the amortization process becomes smaller and smaller, but it still all gets wiped out. I thought I removed those slides. Just a little bit about leases here. Leases are long-term liabilities. We're not going to get into the accounting of leases because it can get rather tricky. Okay, leases were a big thing back in the Sarbanes-Oxley Act and the financial crisis, especially with Enron, what they were doing with leases, because what they were doing was definitely unethical, but technically by law legal, even though the illegality of it was the fraud because they were lying. But what they were actually doing in their accounting practices was a legal loophole, kind of had to deal with leases. So if you move on and you're gonna be an accountant, this will be something to study, a great study in your master's class. But know that leases are long-term debts when they're for 1 year or more. Okay, there's also a thing called, I think I left an amortization on there because I wanted to talk about installment notes. Sometimes you might buy a piece of equipment or something from, like when you buy a new car, you're getting an installment note. Okay, when you make a payment, you're paying back principal and interest at the same time. Okay, it uses an amortization table too. And you're paying more interest at the beginning of the payments than you are at the end of the payments. Okay, and if we had more time, I would really dig into this just as extra knowledge for you and show you exactly how making extra payments, like I'm saying, like a car payment at the beginning of the term when you first get the car and get the loan, how it can lower your overall cost that you're going to pay back quite nicely. But basically, in summary, no long-term debt includes bonds and long-term notes, anything we expect to pay back over a year. Bonds are sold in $1,000 increments with a stated interest rate. Okay, that interest rate is paid in cash every period wherever they pay it, every 6 months, every year. The difference between the stated rate and what the market rate these bonds are trading for on the open market are different. Creates that premium or discount that we must amortize off. Okay, and just one other thing, another difference between the callable bond, the convertible bonds, stuff, and how to do the journal entry. Okay, so that's it for chapter 9's lecture. Okay, be sure to tune back in for the chapter 9 handout answers, and then hopefully clear up some of the accounting issues and get you through the homework.